Before we begin, a brief disclaimer. This video is for informational and educational purposes only. I am not a financial advisor, and the content presented here should not be considered financial, investment, or career advice. The figures discussed are based on publicly available data, school employment reports, and industry trends, but they are estimates and projections. Your individual outcomes may vary significantly. Please conduct your own thorough research and consult with qualified professionals before making any major financial or career decisions. $250,000. That is the median total compensation for a graduate from a top MBA program in their very first year after graduation. Let that sink in. $250,000. For many people, that's a life-changing number. It's the kind of money that pays off student debt in a few years, buys a house, and sets you on a path to financial freedom. And that number is precisely why you're watching this video. You've heard the hype, you've seen the rankings, and now you're asking the big question. Is a top MBA with its $200,000 price tag and 2 years of lost income still the golden ticket it's cracked up to be? Especially as we look ahead to 2026? The answer is complicated, because that $250,000 figure, the one that schools love to splash across their brochures, it's both completely true and dangerously misleading. It hides a brutal reality of competition, industry pivots, and massive variations in outcomes. Some graduates will clear $300,000 without breaking a sweat. Others will struggle to land a job that even justifies the monumental debt they just took on. The difference between those two outcomes isn't luck. It's information. It's knowing which industries are booming, which schools are pipelines to the highest-paying jobs, and most importantly, how to understand the anatomy of a modern post-MBA compensation package. And that is the promise of this video. We are going to rip apart the glossy marketing numbers and show you the raw data underneath. By the end of this presentation, you will not just know the average salary. You will understand the entire financial landscape of a post-MBA career in 2026. We'll break down the numbers from the top 10 US programs. I'm talking Harvard, Stanford, Wharton, Booth, Kellogg, MIT, Sloan, and the rest of the M7 and beyond. We will dissect the three main career paths: management consulting, investment banking, and big tech. And we will give you the most updated, forward-looking salary, bonus, and stock projections you can find anywhere, so you can make this massive, life-altering decision with your eyes wide open. So let's get into it. The first and most critical mistake people make when evaluating these offers is just looking at the base salary. An MBA recruiter will laugh you out of the room if that's your only focus. The real number, the one that matters, is total compensation. And it's made up of 4 distinct parts. If you don't understand all 4, you're flying blind. Part 1 is the base salary. This is the foundation. It's the guaranteed money that hits your bank account every 2 weeks. For top MBA graduates entering the big 3 career tracks, this number has become surprisingly standardized in recent years. For management consulting, think McKinsey, Bain, or BCG, you should be modeling a 2026 base salary of around $190,000 to $195,000. It's a huge number, but it's table stakes. For investment banking at a bulge bracket or elite boutique firm, you're looking at a similar starting point, typically around $175,000, but we'll discuss in a later part why that number is incredibly deceptive. And for a post-MBA role in tech, like a product manager at Google or a strategy lead at Microsoft, the base salary is often a little lower, ranging from $160,000 to $185,000. Now, the key thing to understand about the base salary is that it's the anchor for your future earnings. Your annual raises and your performance bonus are almost always calculated as a percentage of this base. So while it's not the whole story, it's a critically important first chapter. But here's where the real money starts to kick in. Part 2, the signing bonus. This is the lump sum of cash a company gives you just for saying yes. Think of it as a thank you gift for choosing them, and more practically, as a way to help you cover relocation expenses and survive the months between graduation and your first paycheck. This is where we start to see some major differences. In management consulting, the signing bonus is almost universally a flat $30,000. It's non-negotiable. It's the standard. Investment banking, however, plays a different game. The signing bonus is much larger, typically starting at $50,000 and can sometimes go higher, plus they often throw in a relocation stipend on top of that. Why? Because they know the lifestyle is a grind, and they need to sweeten the pot up front. In tech, the signing bonus is the most variable. It can range from as low as $25,000 to as high as $70,000 or more. This is one of the first major levers a tech company will pull during a negotiation. especially if they are competing with a high-paying consulting or banking offer. A $50,000 signing bonus is not just a nice chunk of cash. It's a signal of how badly that company wants you. So, if we take a consulting offer, we're at a base of $190 plus a $30,000 signing bonus. That brings our first-year cash to $220,000 before we've even talked about the most powerful component of your annual earnings. Part 3, the performance bonus. This is where your individual and the company's success directly translates into your bank account. It is the single biggest differentiator in your cash compensation from year to year. This is not a guaranteed Christmas bonus. This is a formula-driven payout that can be wildly lucrative. In consulting, your year-end performance bonus is a percentage of your base salary, and it's tied to your performance rating. For a top performer at a firm like McKinsey, this can be upwards of $50,000 in your first year alone. So you add that to your $190 base and $30,000 sign-on, and you are now clearing $270,000 in your first 12 months. This is how that headline number starts to become a reality. In investment banking, the bonus culture is legendary, and it's even more extreme. The bonus isn't just a part of your compensation. It is your compensation. It's not uncommon for a first-year associate's bonus to be 50 to 100% of their base salary. Yes, you heard that right. You could make a $175 base and get a $175 bonus. Suddenly, that banking job looks a lot more appealing than the consulting gig, at least on a pure cash basis. This is why you cannot compare these jobs by looking at base salary alone. In tech, the performance bonus is typically more modest as a percentage of base, often in the 15 to 25% range. A product manager at Google might have a target bonus of 15%. If they have a great year and the company does well, that might get multiplied to 20 or 25%. So on a 170 base, that's a bonus of around $34,000 to $42,000. It's significant, but it rarely reaches the massive heights of a banking bonus. But tech has a secret weapon, a fourth component of compensation that, over the long term, can dwarf everything else we've just discussed. And that is Part 4, equity compensation. This usually comes in the form of restricted stock units or RSUs. This is not cash. This is ownership. It's a grant of company stock that vests over a period of time, typically 4 years. When you get an offer from a company like Amazon, Google, or Apple, they won't just offer you a salary and a bonus. They'll offer you a stock grant worth, for example, $200,000. This grant vests over 4 years, meaning you get $50,000 worth of stock each year, on top of your salary and your performance bonus. This is the game changer. This is how tech compensates for its slightly lower base salaries and cash bonuses. And this is the component with unlimited upside. If the company's stock price doubles over your 4 years, the value of your grant doubles. That $200,000 grant is suddenly worth $400,000. This is how fortunes are made in Silicon Valley. It's also riskier. If the stock price goes down, your compensation goes down with it. So, to recap, we have 4 pillars: base salary, the foundation; the signing bonus, the upfront cash; the performance bonus, the reward for a great year; and equity, the long-term wealth builder. You absolutely must analyze an offer across all 4 of these categories to understand its true value. A $160,000 base salary offer from a tech company might seem low compared to a $190,000 from a consulting firm. But when you factor in a $60,000 signing bonus and a $300,000 stock grant, the tech offer could be worth vastly more over 4 years. Understanding this math is the first step to truly understanding the financial power of a top MBA. So let's break down that math, starting with the 3 dominant industries that vacuum up the majority of graduates from schools like Harvard, Stanford, and Wharton. We're talking about consulting, finance, and big tech. These aren't just jobs, they are entire ecosystems, each with its own language, culture, and most importantly, its own unique way of compensating you. Let's start with the king of post-MBA recruiting, management consulting. This is the path for the problem solvers, the framework lovers, the PowerPoint wizards. We're talking about the big 3: McKinsey, Bain, and BCG, or MBB as they're known. For decades, they have been the single largest employers of top MBA talent, and they pay for it. In 2026, a newly minted MBA walking into one of these firms can expect a base salary right around $205,000. Let's just pause on that. $205,000. For many people, that's a distant late career goal. For a top MBA, it's the starting line. But that's just the appetizer. On top of that base, you'll get a signing bonus. Think of this as the golden hello, a thank you for choosing them over their competitors. This will be a check for about $35,000 that hits your bank account before you've even analyzed your first spreadsheet. So right out of the gate, before working a single day, you are at $240,000. But the real differentiator in consulting is the performance bonus. This isn't a guaranteed Christmas bonus. It's a direct reflection of your perceived value to the firm that year. It's typically paid out at the end of the year and can range from a respectable $20,000 to a mind-boggling $60,000 or more for top performers. So, if you're a rockstar consultant in your first year, your all-in first-year cash compensation could realistically hit $300,000. And the firms don't stop there. Many will contribute an additional 7 to 10% of your salary directly into a retirement account for you. A little nest egg that amounts to another $15,000 to $20,000 a year you don't even have to think about. Some will even offer tuition reimbursement for your second year of business school, which could be another $80,000 paid back over 2 years. The perks are designed to make an unbelievably demanding job just a little more palatable. Because make no mistake, you will earn every single penny of that salary, flying from city to city, living out of a suitcase, and working 80-hour weeks to solve a client's most intractable problems. It's a trial by fire, but one that leaves you with a bank account and a resume that can open almost any door. Now let's pivot to the second titan of MBA recruiting, finance. Specifically, investment banking. If consulting is about strategy, banking is about the deal. It's a world of high stakes, high pressure, and even higher bonuses. This is the path for the adrenaline junkies, the spreadsheet modelers who dream in discounted cash flows. We're talking about the bulge bracket banks, Goldman Sachs, Morgan Stanley, JP Morgan. The compensation structure here is fundamentally different from consulting. It's designed to be a roller coaster. The base salary for a post-MBA associate in 2026 will be around $190,000. A bit lower than consulting, you might notice. The signing bonus, however, is often significantly higher, ranging from $60,000 to $80,000. They want to lock you in early and make it painful to walk away. So your guaranteed first-year cash is already north of $250,000. But the base and the signing bonus are not the main event. In investment banking, your entire year revolves around one thing: the year-end bonus. This is the big kahuna. It's a black box, a number decided in the smoke-filled rooms of upper management that reflects your personal performance, your group's performance, and the overall health of the market. And it is massive. In a decent year, a first-year associate can expect a bonus that is anywhere from 70% to 100% of their base salary. Let's do that math. A $190,000 base salary, plus a $150,000 bonus. Add in the signing bonus, and you are looking at a first-year cash compensation well over $400,000. $400,000 in your late 20s. It's a staggering amount of money, and it's why people are willing to endure the legendary 100-hour workweeks, the canceled vacations, and the life-or-death pressure of closing a multi-billion-dollar deal. You are sacrificing your time, your sleep, and your social life for a few years in exchange for a level of financial security that most people will never experience. It's a devil's bargain, but for many, it's a bargain they are more than willing to make. And that brings us to the third, and increasingly popular destination: the tech industry. If consulting is the brain and banking is the guts, tech is the future. This is the path for the builders, the innovators, the product visionaries who want to ship code that impacts a billion users. We're talking about the giants: Google, Meta, Apple, Amazon. The tech compensation model is a hybrid, a beautiful and sometimes confusing mix of cash and equity. It's a long-term play. A post-MBA product manager, one of the most coveted roles, can expect a 2026 base salary of around $175,000. On top of that, you'll get a signing bonus, probably in the realm of $50,000 to $75,000. So far, it seems pretty comparable to the other two, maybe a little less than banking. You'll also get an annual performance bonus, but it's typically smaller than in finance or consulting, maybe 15% to 20% of your base salary. So let's say another $30,000. All in, your first-year cash might be around $280,000. Solid, but not the eye-popping number from investment banking. But here is where everything changes. The single most important part of a tech offer isn't the salary or the bonus. It's the 4 letters that can make you a millionaire. RSU. Restricted stock units. This is equity. This is ownership. The company is giving you a piece of itself. A typical offer for a top MBA at a company like Google might include a grant of $350,000 in RSUs. Now, you don't get this all at once. It vests, meaning it becomes yours over a period of time, typically 4 years. A common vesting schedule is 25% per year. So, in your first year, on top of your $280,000 in cash, you also get $87,500 worth of stock. Suddenly, your total first-year compensation is almost $370,000, right up there with the bankers. But the real magic happens over time. In year 2, year 3, and year 4, you get another $87,500 in stock. And this is where we come back to the point we started with. That banking offer of $400,000 is mostly cash, and it's phenomenal. But it's for 1 year. The bonus can go up or down. In tech, that $350,000 stock grant is a 4-year promise. And if the company's stock price doubles over those 4 years, that grant is suddenly worth $700,000. Your total compensation skyrockets without you getting a single raise. This is the golden handcuff of big tech. It creates a powerful incentive to stay, to build, and to grow with the company. You're not just an employee, you're an owner. And that fundamental difference in mindset and financial outcome is why, for many MBAs, the lure of Silicon Valley is becoming stronger than the pull of Wall Street or the prestige of McKinsey. So you have 3 distinct paths. Consulting offers a very high, very stable, all-cash foundation. Banking offers the highest potential first-year cash reward, a massive windfall for those willing to pay the price in lifestyle. And tech offers a slightly lower initial cash component, but with the explosive long-term upside of equity. These are the main highways out of business school, but they are not the only ones. What about the roads less traveled? The ones that lead to even greater fortunes, to the truly legendary MBA outcomes? We're talking about the hyper-competitive worlds of private equity and venture capital, where the compensation isn't just in the hundreds of thousands, but in the millions. We're talking about buying entire companies and taking home a percentage of the profits. That's a completely different universe of wealth creation, and we're going to break down exactly how it works next. So let's pull back the curtain on this hidden world. When we talk about buying companies, we're talking about the fiercely competitive, incredibly lucrative industry of private equity, or PE. And if management consulting is about advising companies, and investment banking is about selling them, private equity is about owning them. It's the top of the food chain. The simplest way to understand it is to think of it like flipping a house, but on a massive corporate scale. A PE firm, often called a fund, raises a giant pool of money from investors. Think pension funds, university endowments, and ultra-high net worth individuals. They raise billions, sometimes tens of billions of dollars. Their mission? To go out and find underperforming, undervalued companies to buy. Just like you'd look for a house with good bones, in a great neighborhood that just needs a new kitchen and a coat of paint, a PE fund looks for a company with a solid product or brand that's being mismanaged. Maybe its costs are too high, its marketing is outdated, or it hasn't expanded into new markets. Once the PE firm buys the company, taking it private and off the stock market, the real work begins. This is the renovation phase. They bring in a team of experts, often including recent MBA graduates from schools like Wharton, Harvard, and Stanford, to act as the general contractors. Their job is to fix the company from the inside out. They'll streamline operations, cut unnecessary costs, restructure management, invest in new technology, and maybe even acquire smaller companies to bolt onto the main business. They do whatever it takes to make the company more efficient, more profitable, and ultimately more valuable. They typically hold on to this company for 3 to 7 years. Then comes the final step, the sale. They either sell the now improved, highly profitable company to another larger corporation, or they take it public again through an initial public offering, an IPO. If they did their job right, the sale price is multiples higher than what they paid for it. The difference, minus the initial investment, is pure profit. And that profit is colossal. So, where does a fresh MBA graduate fit into this picture? You don't just waltz out of business school and start buying companies yourself. You join one of these PE firms as an associate or a senior associate. You are the boots on the ground. You're the one building the financial models until 3 in the morning to figure out if a company is a good buy. You're the one flying to a manufacturing plant in Ohio on a Tuesday to analyze its supply chain. You are the one putting together the 100-page presentations that justify a billion-dollar decision. It is one of the most demanding, high-pressure jobs on the planet. But the compensation is designed to match that intensity. And this is where the numbers get truly staggering. A post-MBA private equity professional's pay isn't just a salary. It's a 3-part system. First, you have the base salary. Fresh out of a top program, You can expect a base salary in the range of $175,000 to $225,000. It's a fantastic starting point, higher than almost any other industry, but honestly, in the world of private equity, it's the least important part of your pay. Next comes the annual bonus. This is a cash payment tied to your performance and the firm's performance over the past year. In a decent year, this bonus will be 100% of your base salary. In a good year, it can be 150% or even more. So let's do the math. With a $200,000 base salary and a 100% bonus, you're already at $400,000 in total cash compensation in your very first year out of school. By your second or third year, hitting $500,000 in cash is standard. This is already an incredible amount of money, but it's not the reason people suffer through 100-hour work weeks. It's not the real prize. The real prize, the holy grail of finance, is the third part of the compensation: carried interest. Carry for short. This is the mechanism that creates generational wealth. This is how people in their early 30s become multimillionaires. Carried interest is your share of the fund's profits. It's your slice of the upside from flipping those companies. Let me explain. Private equity firms typically operate on a 2 and 20 fee structure. The 2 means they charge their investors a 2% management fee on the total fund size each year. So, for a $10 billion fund, that's $200 million a year. That money pays for the fancy offices, the private jets, the data subscriptions, and of course everyone's base salaries and bonuses. Keeps the lights on. The 20 is the important part. That's the carried interest. It means the firm gets to keep 20% of all the profits it generates for its investors. The other 80% goes back to the investors. That 20% profit share is the carry pool, and it's distributed among the partners and employees of the firm. As a post-MBA associate, you get a small piece of that pool. It might be a tiny percentage, say 0.1% or 0.25%. That sounds like nothing, but let's run the numbers on that $10 billion fund. Let's say over 7 years the firm does an amazing job, and they turn that $10 billion into $30 billion. That's a $20 billion profit. The firm's 20% share of that profit is $4 billion. $4 billion. Now, your tiny 0.1% stake in that carry pool is suddenly worth $4 million. This is on top of the $500,000 cash salary you've been earning every year. And this isn't a one-time thing. You get carry in every new fund the firm raises. As you get promoted from associate to vice president to principal and finally to partner, your percentage of that carry pool grows exponentially. Partners at major funds can have carry stakes worth tens or even hundreds of millions of dollars. This is the engine of wealth creation in high finance. It's not about saving up your salary. It's about owning a piece of the upside. It's about having equity. This is why the competition for these jobs is beyond fierce. It's a tiny handful of positions available each year. We're talking maybe a few hundred spots across the entire United States. And the firms can be incredibly selective. They aren't just looking for someone with a Harvard MBA. They are looking for someone who also spent 2 to 3 years before business school working as an investment banker at Goldman Sachs or Morgan Stanley, or as a consultant at McKinsey or Bain. It's a very specific, very narrow pipeline. They want people who have already been through the grinder, who have proven they can handle the pressure and the analytical rigor from day one. There is no on-the-job training. You are expected to be a world-class financial athlete the moment you walk in the door. The lifestyle is brutal. The pressure to perform is immense. It's an up or out culture, meaning if you don't get promoted, you're asked to leave. You sacrifice your 20s and much of your 30s, but the reward for those who succeed is a level of financial freedom that is almost unimaginable. It's the absolute pinnacle of post-MBA earnings, but it's also the most exclusive and demanding path. It requires a very specific background even before you set foot on a business school campus. So what if that's not you? What if you're a brilliant engineer from Stanford with a groundbreaking idea? Or a marketing prodigy from Kellogg who understands consumer behavior better than anyone? Is the door to multi-million-dollar compensation closed to you? Not at all. There's another world just as lucrative, but with a completely different mindset. It's not about fixing the old, it's about funding the new. It's the world of venture capital, and the way they make money is a whole different ballgame. We'll explore that next. Venture capital is a world built on a single intoxicating belief that a small team in a garage with a brilliant idea can, with the right funding and guidance, become the next Google, the next Amazon, the next paradigm-shifting force in our economy. While Sarah, our private equity professional, is a master of financial engineering, meticulously optimizing existing businesses for profit. Her classmate, Alex, is a prospector, a gambler, a believer. He didn't want to buy a company. He wanted to back a founder. He didn't want to manage cash flows. He wanted to fuel a revolution. For him, the MBA wasn't about learning to run a stable enterprise. It was about learning to identify and nurture explosive, unpredictable growth. This is the fundamental difference. Private equity buys the whole company, or at least a controlling stake. They use debt, they take over the board, they are in charge. Venture capitalists or VCs do the opposite. They take a small minority stake. They don't want to run the company. They want to advise the visionary founder who does. They are betting on people as much as they are on technology, and their entire compensation structure is designed around one thing: the Grand Slam home run. So, how does Alex, fresh out of a top MBA program, break into this world, and what does he actually make? He starts as an associate, and the very first thing he learns is that the upfront money is surprisingly unimpressive. Compared to his peers in private equity or investment banking, his starting salary feels almost modest. We're talking about a base salary in the range of $160,000 to $190,000. The bonus is also smaller, often between 30% and 50% of that base. So, all in, Alex might be looking at $220,000 to $270,000 in his first year. It's a huge amount of money for anyone in the real world, but in the hyper-competitive bubble of top MBA grads, he's looking at his friend Sarah in PE who cleared over $350,000, and he's wondering if he made the right choice. But Alex isn't here for the salary. He's here for the education and the access. His job as an associate is to be the firm's eyes and ears. He is drinking from a fire hose every single day. He's taking hundreds of calls with founders, sifting through thousands of pitch decks, trying to find the 1% of the 1% that might be a viable investment. He's building financial models based on projections that are more art than science. He's doing market research, talking to customers of a product that barely exists, and writing exhaustive investment memos arguing why his firm should risk millions of dollars on a company with no revenue and a team of 5 people. He's learning to see the future. If he's good, if he can spot trends, build a network, and show incredible judgment, he'll get promoted to principal in a few years. Here, the compensation gets a bit more serious. His base salary might jump to the $250,000 to $300,000 range, with a bonus that could push his annual cash compensation toward $400,000. He's now leading deal teams, taking a board observer seat at portfolio companies, and his voice carries real weight in investment decisions. He's no longer just filtering, he's a tastemaker. But even at this level, he's not touching the real money. He's still playing for something else, something esoteric and almost mythical to outsiders: carried interest. This is the secret. This is the reason people take a lower cash salary to work in venture capital. Carried interest, or carry, is the VC firm's share of the profits from a successful fund. To understand this, you have to understand the basic VC business model, often called 2 and 20. Imagine Alex's firm raises a new fund. They go to big institutional investors, pension funds, university endowments, wealthy families, and convince them to commit capital. Let's say they raise a $200 million fund. The 2 in 2 and 20 refers to a 2% annual management fee. So, the firm gets 2% of that $200 million, which is $4 million a year. That $4 million is what pays for the fancy office, the travel, and, most importantly, Alex's salary and bonus. Keeps the lights on. The 20 is where the magic happens. It represents 20% of the profits. So, the firm invests that $200 million into 30 or 40 different startups over a few years. The vast majority of these startups will fail and go to zero. Some will do okay, maybe returning the money invested. But the hope is that 1 or 2 of them become massive successes, they get acquired by a tech giant, or they have a huge IPO. Let's say, after 10 years, the fund's investments are now worth $1 billion. The firm first returns the original $200 million to its investors. The remaining $800 million is pure profit. The VC firm is entitled to 20% of that profit. 20% of $800 million is $160 million. That $160 million is the carry pool. This pool of money is distributed among the partners and senior members of the firm. As a principal, Alex might be granted a small piece of this carry, maybe half a point or 1%. 1% of a $160 million carry pool is $1.6 million. Now, this isn't a check that arrives on a Tuesday. It's paid out over several years as the fund's investments are sold off. And it was never guaranteed. If the fund had only broken even, the carry would be zero. This is the VC lottery ticket. And if Alex makes it to partner, his life changes completely. A junior partner might get 2 to 3 points of carry. A senior general partner who founded the firm might command 10 points or more. Do the math. 10% of that $160 million pool is $16 million. And a successful partner is investing out of multiple funds at once, each with its own carry potential. This is how you get multi-generational wealth. It's not from the salary, it's from a handful of incredibly successful bets that pay off a decade later. So let's recap Alex's journey. In his first few years, his cash compensation is in the low to mid 200,000s. He's working insane hours, facing constant rejection, and making less cash than his MBA peers. By year 5 as a principal, he's pushing $400,000 in cash, but now he has a taste of carry. It's just numbers on a page, a promise of a future payout that might never come, but it's enough to keep him in the game. The reality is that this path is a brutal tournament. The number of associate roles is tiny, and the number of partner slots is even smaller. The odds of the fund you join being a top quartile performer that actually generates significant carry are slim. You are betting your career not just on your own ability, but on the collective genius of your partners and, most importantly, on the grit and vision of the founders you back. It's a world of delayed gratification, of extreme risk, and of intellectual curiosity. Alex traded the certainty of a high 7-figure income in private equity for the moonshot of a 9-figure outcome in venture capital. He bet on the future, and on his ability to see it before anyone else. So we have Sarah, the operator, the optimizer, remaking the old industrial world for maximum profit. And we have Alex, the futurist, the kingmaker, funding the new world into existence. They represent two of the most powerful and lucrative paths for an MBA graduate. But both of their worlds, the world of multi-billion-dollar buyouts and the world of unicorn startups, rely on a third, even more intense and arguably more foundational pillar of high finance. This is the world that advises on the deals, that raises the debt, that takes the companies public. It's the engine room of Wall Street, the world of investment banking. Investment banking compensation isn't just a salary, it's a language. It's a complex, often brutal, and incredibly motivating system designed for one purpose: to attract the most competitive, intelligent, and resilient minds from schools like Wharton, Booth, and Columbia, and then work them to the absolute brink of their human capacity. Because when a single M&A deal can generate $50 million in advisory fees for the bank, paying someone $500,000 to make sure it doesn't fall apart suddenly seems like a rounding error. It's the cost of doing business at the highest level. So let's break down that number. Let's dissect the anatomy of a post-MBA investment banker's first-year pay, because it's not just one number. It's a carefully constructed package of base, bonus, and signing incentives. First, the foundation, the base salary. This is the most straightforward part of the equation. For decades, the top banks on Wall Street have engaged in a compensation arms race, and the base salary for a newly minted MBA associate is the starting pistol. They all move in lockstep. If Goldman Sachs raises its base, you can bet that JP Morgan, Morgan Stanley, and Bank of America will announce a matching increase within weeks. It's a matter of prestige. They cannot afford to be seen as the cheaper option for top-tier talent. As of the last major bump, the industry standard for a first-year associate out of a top MBA program was $175,000. But that was years ago. With inflation, the talent war, and the sheer profitability of these divisions, we're seeing an aggressive upward trend. By the time the class of 2026 walks onto the trading floor, you should expect that base salary to be standardized at or around $225,000. This is your bi-weekly paycheck. It's the money you can count on, the number you put on your apartment application. But in the world of banking, nobody gets excited about the base salary. It's just the table stakes. The real game is the bonus. And you don't even have to wait a full year to get your first taste. Most MBA graduates start in the summer, usually late July or early August. Come December, when the bank is calculating its annual bonuses, you've only been there for about 5 months. You haven't worked a full year, so you don't get a full year bonus. Instead, you get what's called a stub bonus. It's a prorated bonus for your first few months of work. And even this stub is often more than what many people make in an entire year. For a first-year associate in 2026, a typical stub bonus will land somewhere between $50,000 and $80,000. It's the bank's way of saying, "Welcome to the show. We see you grinding at 2 a.m. Here's a down payment on your soul." So you start in August. By December, You've already added an $80,000 stub bonus to your $225,000 base salary. You're 5 months in and tracking at over $300,000. But the main event, the number that defines your year, that separates the stars from the pack, is the full year bonus. This is paid out in your second year, after your first full calendar year on the job. And this is where the numbers get truly staggering. Unlike the base salary, the bonus is anything but standardized. It is a brutally subjective and data-driven assessment of 3 things: the performance of the overall bank, the performance of your specific group, and your individual performance within that group. First, the bank. Did the firm have a record year, or did the markets tank? This sets the overall bonus pool. A rising tide lifts all boats. Second, your group. Are you in a hot sector like technology or healthcare M&A that's printing money? Or are you in a slower group? The bankers closing the biggest deals will see their group's bonus pool swell. Finally, and most importantly, you. At the end of the year, you go through a grueling 360-degree review process. Every managing director, vice president, and even fellow associate you worked with ranks you. Are you a rock star who catches mistakes, builds flawless models, and can be trusted with a client? Or are you average? They literally rank you in buckets: top bucket, middle bucket, bottom bucket. Your bonus is a direct reflection of that ranking. So what does that look like in 2026? For a first-year associate who completes their first full calendar year, the bonus, that one single wire transfer that hits your account in January or February, will range from 80% to over 150% of your base salary. If you're in the bottom bucket at a bank that had a mediocre year, you might be looking at a bonus of $180,000. But if you are a top bucket performer in a top group at a bank that crushed it, you could be looking at a bonus of $300,000, even $350,000 or more. Let's do the math. A $225,000 base salary plus a $300,000 bonus. That's an all-in compensation of $525,000 in your first full year out of business school. And we haven't even mentioned the signing bonus, which is typically around $50,000 to $75,000, paid to you before you even start just to lock you in. So, a realistic all-in compensation range for a top MBA graduate going into investment banking in 2026 is between $450,000 and $600,000. The variation depends on that bonus, on you, your group, and your bank. Now, a critical distinction needs to be made here. Not all banks are created equal. You have the bulge brackets, the giant, household names like Goldman Sachs, JP Morgan, and Morgan Stanley. They do everything: M&A, capital markets, sales and trading, wealth management. Then you have the elite boutiques, firms like Centerview Partners, Evercore, and Lazard. These are smaller, more specialized firms that focus almost exclusively on providing advice, primarily for mergers and acquisitions. For a long time, the bulge brackets were the undisputed kings of compensation. But the game has changed. Elite boutiques don't have the massive overhead of a commercial bank. They are lean, mean advisory machines. Because of this, they can often pay their bankers more, especially in cash. While a bulge bracket bonus might include a significant portion of deferred stock, an elite boutique is more likely to write you a bigger check. It's not uncommon for the top associates at places like Centerview or Evercore to clear over $600,000 or even $700,000 in a great year, out-earning their peers at the larger banks. The trade-off? The brand name might not be as universally recognized. And in a market downturn, a smaller, specialized firm can be more volatile. People hear these numbers and they ask, why? Why would anyone be paid that much money? Seems insane. But you have to understand the scale of the business. An associate isn't just an analyst. They are the quarterback of the deal team. They are the ones building the complex valuation models, coordinating with lawyers and accountants, and putting together the 100-page pitch books that a managing director will use to convince a CEO to make a $10 billion acquisition. That one deal might bring the bank $70 million in fees. The bank is paying you $500,000 to be the engine for a machine that generates tens of millions. In that context, you're not an expense. You're a phenomenal return on investment. This world of banking is a crucible. It's designed to forge the most resilient, detail-oriented, and financially sophisticated professionals on the planet. And it pays them accordingly. But for many, it's not the final destination. It's a training ground. It's a 2 to 3 year post-MBA bootcamp where you master the art of the deal. Because after you've learned how to advise on the biggest transactions in the world, the next logical step is to be on the other side of the table. To stop advising and start buying. To move from selling the companies to owning them, this is the leap to the buy side, the world that many consider the true pinnacle of a career in finance. The world of private equity. Private equity isn't just a career. For many, it's the destination. It's the final boss level of the finance world. And the reason is simple: ownership. In consulting, you give advice. In banking, you facilitate deals. In private equity, you buy the company. You own the assets, you own the decisions, and most importantly, you own the outcome. Think of it like this. An investment banker is like a high-end real estate agent who helps a wealthy client buy a mansion. They earn a fantastic commission on the sale. A private equity professional is the person who buys a dilapidated but historic mansion with incredible potential, using a combination of their own money and a lot of borrowed money. They then spend the next 5 years gut renovating it, modernizing the systems, restoring its glory, and turning it into the most desirable property on the block. Then they sell it for 3, 5, or even 10 times what they paid. And they keep a huge chunk of that profit. Now scale that mansion up to a $1 billion manufacturing company, a chain of dental clinics, or a software business. That's private equity. Firms like Blackstone, KKR, and Carlyle are the titans of this world. They are notoriously, almost impossibly, difficult to break into. They don't hire hundreds of analysts out of college. A large PE fund might only hire a handful of post-MBA associates each year. And they are looking for a very specific pedigree. They almost exclusively recruit from 2 pools: former investment banking analysts or former management consultants who have spent 2 to 3 years in the trenches before going to business school. The top 10 MBA, especially from places like Harvard, Stanford, and Wharton, is the final non-negotiable stamp of approval. It's the ticket that gets you into the room. So what does the key to this kingdom actually pay? The compensation structure in private equity is designed to make you think like an owner because you are one. The base salary for a post-MBA associate in 2026 will start high, likely in the range of $200,000 to $225,000. It's a great number, but it's not the main story. Then comes the annual bonus. This is directly tied to your performance and the firm's performance, and it's substantial. You can expect a year-end bonus of 100 to 150% of your base salary. So, right out of the gate, your all-in cash compensation for year 1 is likely to land somewhere between $400,000 and $550,000. That alone places it at the very top of the post-MBA food chain. But it's not what creates the legendary generational wealth that PE is famous for. That comes from a single magical concept: carried interest. Or, as it's known in the industry, carry. Carry is your share of the fund's profits. It's the ultimate incentive. The standard model for a PE fund is 2 and 20. They charge investors a 2% management fee on the assets they manage, which pays for salaries and office space. But the real money is in the 20. That means the firm, the partners, and the employees gets to keep 20% of all the profits they generate after returning the investor's original capital. This is the pot of gold. As a new associate, you are granted a small number of carry points, which represent your slice of that 20% profit pool. Let's be clear. This is not cash you get on day 1. It vests over many years, and it only pays out if and when the companies in your fund are sold for a profit. It's a long-term game, but the numbers can be staggering. A successful fund can triple or quadruple its investors' money over its 10-year life. Your small slice of the profits from a multi-billion-dollar fund can translate into millions of dollars, completely separate from your salary and bonus. As you get promoted from associate to vice president to principal, and finally to partner, your allocation of carry points grows exponentially. This is how you see finance professionals with net worths in the tens or even hundreds of millions of dollars. They didn't get there from their salary. They got there from their carry. But this reward comes at a cost. The lifestyle is relentless. The hours can be even more grueling than investment banking because the stakes are infinitely higher. When a deal is going sideways, you can't just write a memo and go home. You own the company. It's your problem. The pressure to perform, to find good deals, to improve the companies you own, and to generate returns for your investors is immense and never-ending. The culture is famously intense, a shark tank of the brightest and most ambitious minds in finance, all competing for the same prize. Now, there is another side to the buy-side coin, a world that shares the same DNA as private equity, using other people's money to buy stakes in companies, but with a radically different philosophy. If private equity is about buying the present and optimizing it, this other world is about buying a lottery ticket on the future. It's the land of dreamers, of exponential growth curves, of betting on unproven ideas and visionary founders. This is the world of venture capital, where a PE fund might buy a 100-year-old company that makes ball bearings. A venture capital, or VC, fund gives a 25-year-old Stanford dropout a check for $5 million to build a flying car in her garage. VC is the fuel for Silicon Valley and the entire startup ecosystem. Firms like Andreessen Horowitz, Sequoia Capital, and Kleiner Perkins aren't buying mature, cash-flowing businesses. They are investing in early-stage, high-risk, high-potential reward companies, hoping that one of them becomes the next Airbnb, Stripe, or SpaceX. The VC model is a game of home runs. They know that 9 out of 10 of their investments will likely fail and go to zero, but that one company that succeeds can return 100x or even 1000x their initial investment, paying for all the failures and generating massive returns for the fund. Getting into VC after a top MBA is like PE, incredibly competitive, but they look for a slightly different profile. While finance skills are important, VCs often value operating experience more. They want people who have worked at a high-growth tech company, who have been product managers, engineers, or even founders themselves. An MBA from a school with deep ties to the tech world, like Stanford or MIT, is a powerful signal, providing the network and financial acumen to complement that hands-on experience. The compensation in venture capital is a fascinating trade-off. Your year-one cash compensation will almost certainly be lower than your friends going into PE or banking. A post-MBA associate at a VC fund in 2026 might see a base salary between $170,000 and $200,000, with a bonus in the 30% to 70% range. Your all-in cash might be closer to $250,000 to $350,000. It's a fantastic living, but you are consciously taking a cash pay cut compared to other elite finance roles. Why would anyone do that? The answer once again is carry. The potential upside in venture capital is, in theory, even more explosive than in private equity. While a great PE deal might triple or quadruple your money, a legendary VC investment can create life-altering wealth. Imagine being an early investor in Uber or Facebook. That single investment can make an entire fund, and the carry payout can be astronomical. However, the risk is also far greater. Your fund could completely strike out, miss the next big thing, and return nothing. Your carry could end up being worthless. It's a high-variance bet on the future. The lifestyle and culture are the other major draw. The hours are generally more civilized than in PE. The job is less about building complex financial models until 3 a.m. and more about networking, meeting with brilliant founders, understanding new technologies, and developing a thesis about where the world is heading. It's a job of intellectual curiosity. The stress isn't about optimizing a debt structure. It's the constant, nagging fear of missing out, the FOMO of passing on the one company that changes the world. So you have two paths to the promised land of ownership. The private equity path, built on financial discipline, operational control, and predictable cash flows. And the venture capital path, built on vision, technological optimism, and asymmetric bets on the future. Both offer a shot at unimaginable wealth, but through fundamentally different lenses. But what if you don't want to just invest in the next Google? What if you want to go build it? That's where the tech giants come in, and their compensation packages are a whole different beast. We're talking about a world where stock isn't just a bonus. It's the main event. And when we say the main event, we're not exaggerating. In the worlds of consulting and finance, your compensation is a predictable formula of salary plus bonus. It's a cash-based world. But in tech, you enter a parallel universe governed by 4 letters: R, S, U, restricted stock units. This is the engine of wealth creation in Silicon Valley, and for a top MBA graduate, it's the key that unlocks staggering levels of compensation. But first, let's address the elephant in the room. Why would a company like Google, overflowing with PhDs in computer science, even need an MBA? They don't hire you to code. They hire you to be the connective tissue between the code and the customer, the bridge between engineering genius and market dominance. They hire you for 3 key roles: product manager, strategy and operations, and corporate development. The product manager, or PM, is the most coveted post-MBA role in tech. You are the mini CEO of a product or feature. You don't manage people directly, but you command immense influence. You're in a room with engineers, designers, and marketers, and you are the one who has to answer the impossible questions. What should we build next? Who is it for? How will it make money? How do we beat the competition? You need the business acumen of a consultant, the user empathy of a designer, and enough technical literacy to earn the respect of your engineering team. It's one of the most challenging and rewarding jobs on the planet. Then you have strategy and operations, often called BizOps. Think of this as the internal consulting group for a tech giant. While the PMs are building the ship, BizOps is charting the course. They tackle the massive, ambiguous problems the CEO is losing sleep over. Should we launch our cloud services in Southeast Asia? What's the 5-year strategy for our augmented reality division? How do we optimize the sales model for our enterprise software? It's a direct pipeline to leadership, solving the company's most critical puzzles. Finally, there's corporate development or corp dev. These are the deal makers. When you read that Google bought a hot AI startup for $1 billion, that deal was orchestrated by the corp dev team. It's a high-stakes role that blends finance, strategy, and negotiation, deciding which companies to acquire to secure the mothership's future. So, how do these roles get paid? This is where the numbers start to get a little crazy. Let's build the 2026 projected compensation package for a new MBA graduate entering a top tech firm as a product manager. First, the base salary. It's strong, but surprisingly, it's often lower than what you'd see in consulting or investment banking. You're looking at a range of about $165,000 to $190,000. Let's call it $180,000 for our example. This is your reliable take-home pay that covers the mortgage in your outrageously expensive Bay Area apartment. Next, the signing bonus. This is a nice upfront chunk of cash to welcome you to the company. It's typically between $40,000 and $70,000. We'll pencil in $60,000. It helps with moving costs and makes that first year feel particularly lucrative. Then there's the annual performance bonus. Unlike the near-guaranteed bonuses in banking, this one is more variable, tied to both your individual performance and the company's. It's usually targeted at around 15 to 25% of your base salary. Let's be conservative and say a 20% target, which adds another $36,000. So far so good. We're at 180 base, 60 signing, 36 bonus. That's $276,000. A fantastic income. But it's not what draws people to tech. The final piece is the rocket fuel, the restricted stock units. A top MBA hire at a major tech firm can expect an initial RSU grant of anywhere from $300,000 to over $500,000. Let's use around $400,000 for our example. Now this isn't cash. It's a promise of stock, and it's granted to you over a 4-year vesting schedule. A common schedule is 25% per year. So, in your first year, $100,000 of that stock becomes yours. Let's add it all up. $180,000 base, $60,000 signing bonus, $36,000 target performance bonus, and $100,000 from your first year of vested stock. The grand total for your first year out of business school? $376,000. And here's the magic. That $400,000 grant was valued on the day you signed your offer. If over the next 4 years the company's stock price doubles, which is not at all uncommon for a thriving tech giant, your $400,000 grant is now worth $800,000. Your annual stock compensation just went from $100,000 to $200,000. This is how you see tech employees reaching total compensations of $500,000, $600,000, $700,000 just a few years into their career, without ever getting a single promotion. They are riding a rocket ship, and their compensation is tied directly to the fuel. Of course, not all tech companies are created equal. The biggest MBA recruiter year after year is Amazon. They hire legions of MBAs into senior product manager and leadership development roles. Their culture is famously intense and data-driven. Their compensation is also known for being heavily backloaded. They might give you a huge RSU grant, but the vesting schedule could be something like 5% in year 1, 15% in year 2, and then 40% in years 3 and 4. They are making a massive bet that you'll stay for the long haul to get that giant payday. Then there's the dream destination for many, Google. The culture is legendary, built on engineering excellence and a bottom-up approach to innovation. Getting a PM offer at Google is considered one of the ultimate prizes of the MBA journey. Their compensation is robust and generally more balanced than Amazon's, with a more even vesting schedule, making that year 1 and year 2 pay feel incredibly strong. Meta, the parent company of Facebook and Instagram, is all about speed and impact. Their mantra was move fast and break things, and that ethos still defines the culture. They hire a lot of PMs and value people who can ship products quickly and drive user growth. Their stock has been more volatile, which adds a layer of risk and reward to the RSU equation. A grant from Meta is a high beta bet on the future of social connection and the metaverse. And you can't ignore the quiet titan Microsoft. Under Satya Nadella, it has transformed into an absolute powerhouse in cloud computing and AI. For MBAs looking for massive scale, enterprise-level challenges, and arguably a better work-life balance than its peers, Microsoft has become an incredibly attractive destination with compensation packages that are fiercely competitive. But what if you want to take on even more risk for an even bigger reward? That's where the pre-IPO unicorns come in, companies like Stripe, Databricks, or the next big AI darling. Here the game changes. Instead of RSUs, you're often granted stock options. The base salary might be lower, but you get the option to buy company stock at a very low strike price. If that company has a successful IPO, those options could be worth millions, or even tens of millions of dollars. It's the ultimate lottery ticket, a bet on being part of the team that builds the next Google. But this world of tech riches comes with a catch. The work is relentless. You're surrounded by some of the smartest, most driven people in the world, and the pressure to perform is immense. And those RSUs, they're often called golden handcuffs for a reason. That 4-year vesting schedule is a powerful retention tool. If you decide to leave after 2 years, you could be walking away from $200, $300, $400,000 in unvested stock. It makes leaving incredibly difficult, even if a better opportunity comes along. And your net worth is perpetually tied to the whims of the stock market. A bull run can make you feel like a genius, but a market correction can wipe out hundreds of thousands of dollars of your paper wealth overnight. Tech offers a pathway to wealth that is fundamentally different from the others. It's not about a slow climb up a corporate ladder or a single massive annual bonus. It's about equity. It's about ownership. It's a bet on innovation, on growth, and on the belief that a great idea can change the world and make you rich in the process. We've now covered the 3 great pillars of post-MBA careers: the strategic world of consulting, the high-stakes domain of finance, and the innovation-fueled engine of big tech. For 90% of graduates, the journey ends here. But what about the other 10%? What if you don't want to advise a giant company, or fund one, or even build a product inside one? What if you want to build the entire company yourself from scratch? What if you want to be the founder? That's a path with no guaranteed salary, no bonus, and no RSUs. But with an upside that is quite literally unlimited. This is the path of the builders, the dreamers, the ones who look at the guaranteed $250,000 offer from Goldman Sachs or McKinsey and say, "No thank you. I'd rather make zero." Sounds insane. And in many ways it is. Choosing entrepreneurship right out of a top MBA program is the ultimate bet on yourself. You're trading a beautifully paved, brightly lit superhighway for a machete and a dense, dark jungle with no map. But in that jungle, you have the chance to find a lost city of gold. Let's be brutally honest about the starting salary for a founder coming out of Harvard or Stanford in 2026. It's often nothing. Or it's a tiny stipend you pay yourself from your own savings or a small friends and family investment round. You might be living on $50,000 a year in a city like San Francisco or New York, which is effectively a vow of poverty. Your classmates are closing on apartments, going on lavish vacations, and complaining about their bonus being only $80,000. Meanwhile, you're eating ramen again and trying to figure out why your landing page conversion rate is a catastrophic 0.2%. So why would anyone do this? Because the compensation isn't measured in a monthly paycheck. It's measured in equity, a percentage of a company that, for now, is worth absolutely nothing. It's a lottery ticket, but the MBA provides you with an unfair advantage in this high-stakes lottery. The 2 most valuable assets you gain from a top program for this path are not in the classroom. They are the network and the brand. Imagine a student we'll call Sarah. She gets into Wharton with a fantastic idea for a fintech company that helps gig economy workers manage their unpredictable income. She could have easily taken a director of product role at a big tech firm for $300,000 a year. But she chooses the jungle. In her first semester, she finds her co-founder, a technical genius from the engineering school, in a cross-disciplinary class. Her finance professor, a former venture capitalist, spends hours with her, ripping apart and then helping her rebuild her financial model until it's bulletproof. When it's time to raise a pre-seed round of funding, she doesn't send cold emails into the void. She gets a warm introduction from a Wharton alum, who is a partner at Andreessen Horowitz. That introduction gets her the meeting. Her polished pitch, practiced dozens of times with the school's entrepreneurship club, gets her the check. Suddenly, her company has $1 million in the bank. She can finally pay herself a salary. Maybe it's $80,000. Still a fraction of what her friends in consulting make. But she now owns 40% of a company that investors just valued at $5 million. Her paper net worth is $2 million. Of course, that paper is fragile, could easily burn to ash. But it could also become a diamond. Statistics show that in 2026, the number of graduates starting a business right away hovers around 5% for most top schools, but it spikes to nearly 15 to 18% at places like Stanford's Graduate School of Business, which sits in the heart of Silicon Valley. These new ventures have a shockingly high rate of securing funding. The median seed funding for a startup out of HBS or GSB is now pushing north of $2 million. The school's brand acts as a powerful signal to investors, a de-risking agent that says, "This team is worth the bet." But being a venture-backed founder isn't the only entrepreneurial path. There's a fascinating and increasingly popular route called a search fund. This is entrepreneurship on training wheels. An MBA grad raises a small amount of capital from investors not to start a company, but to find and buy an existing, profitable, but maybe unglamorous business. Think a regional HVAC company, a specialized manufacturing firm, or a chain of dental offices. The grad then steps in as the new CEO to grow it. The salary is solid, often $150 to $180K, plus a bonus tied to performance. But the real prize is the equity they receive in the company they now run, typically 20 to 25%. If they can double or triple the business's value in 5 to 7 years and sell it, their personal payout can be in the millions. It's a path with a much higher success rate than a tech startup, offering a multi-million-dollar upside with less of the existential, ramen for dinner risk. Now let's talk about the most common intersection of MBAs and the startup world. Not as a founder, but as an early employee. This is the sweet spot for many. You're joining a company that has already found its product market fit, has raised a Series A or B round of funding, and is ready to scale. They aren't looking for junior analysts. They need leaders. They need a head of growth, a director of a new business line, a chief of staff to the CEO. These are roles an MBA is uniquely qualified for, bringing a strategic toolkit to a team of brilliant builders who might lack formal business structure. What does that compensation look like in 2026? It's a hybrid. The base salary is a compromise. It won't match banking, but it's comfortable. Think $170,000 to $200,000. There might be a small performance bonus, but the life-changing component is, once again, the equity. You'll be granted stock options, representing a small slice of the company, maybe 0.1 or 0.25%. This is where the math gets exciting. Let's say you join a red-hot AI startup valued at $50 million as their director of strategy. Your salary is $190K. Your stock option grant is for 0.25% of the company. On paper, that equity is worth $125,000, vesting over 4 years. It's a nice perk. But if that company becomes the next Datadog or Snowflake, and in 5 years it goes public or gets acquired for $5 billion, your 0.25% stake is now worth $12.5 million. That one decision to join an early-stage company completely changes your financial trajectory in a way that even a decade in private equity might not. Of course, we have to address the giant flashing red warning sign. 9 out of 10 startups fail. That equity, that lottery ticket, is far more likely to be worth zero than it is to be worth $12 million. This is the risk you take. You're trading the certainty of a high 6-figure income for the possibility of an 8-figure one. And this is the final crucial role the top-tier MBA plays. It's your safety net. It's the ultimate shock absorber for career risk. Let's say Sarah's fintech startup burns through its cash and fails after 2 years. It's a painful, devastating experience. But she doesn't end up on the street. She updates her LinkedIn profile. She's now a founder who has experience building a team, pitching VCs, developing a product, and managing a P&L. She calls the recruiter at McKinsey who gave her an offer 2 years ago. They see her not as a failure, but as someone with invaluable, real-world operational experience. She can likely step right back onto that traditional path, perhaps even in a more senior role than she would have been in otherwise. The MBA allows you to take the leap, knowing there's a golden parachute strapped to your back. So the average salary for an MBA entrepreneur is a misleading concept. It's a bimodal distribution of near zeros and spectacular, life-altering home runs. It's a path defined not by a predictable annual bonus, but by the relentless pursuit of an asymmetric outcome, where the downside is capped but the upside, the dream of building something from nothing, is truly infinite. But what if you want the impact of building something new, without the insane risk of a startup? What if you want to be an entrepreneur, inside a Fortune 500 giant, or join a leadership program designed to mint future CEOs? That's a different kind of golden ticket, and the compensation looks very different. Let's talk about the road less traveled by MBA hardos, but a road paved with a different kind of gold. This is the path of the builder, the operator, the corporate titan in training. These are the people who look at the insane hours of an investment banker or the up-or-out pressure of consulting and say, "No thanks. I don't want to advise the king. I want to be the king." And for them, the most coveted prize isn't a job. It's a spot in a leadership development program, or an LDP. Think of an LDP as an express elevator to the C-suite of a Fortune 500 company. These are highly selective rotational programs where a company like Johnson & Johnson, Danaher, or Amazon invests millions into molding you, an MBA graduate, into a future executive. For 2 to 3 years, they rotate you through critical business functions, marketing, finance, operations, strategy, giving you a 30,000-foot view of the entire enterprise. You're not a junior analyst fetching coffee. You are given real P&L responsibility, you manage teams, you launch products. You are being groomed. So, what does the grooming process pay in 2026? It's not the headline-grabbing number of a private equity associate, and that's by design. The value proposition is different. The base salary for a top-tier LDP at a major CPG, healthcare, or industrial firm is landing in the range of $175,000 to $190,000. Now, before you scoff, let's build the rest of the package. The signing bonus is still substantial, typically between $40,000 and $60,000. The target performance bonus is also very real, usually pegged at 20 to 30% of your base salary. So, let's do the math on the conservative side. $175,000 base, a $40,000 signing bonus, and a 20% performance bonus of $35,000. Right out of the gate, you're looking at a first-year cash compensation of $250,000. But here's where it gets interesting, the equity. Unlike the lottery ticket of startup options, this is the steady, reliable wealth builder of restricted stock units, or RSUs, from a blue-chip company. The initial grant for an LDP graduate in 2026 will be in the ballpark of $100,000 to $150,000, vesting over 4 years. So, in your first year, you're adding another $25,000 to $37,500 to your total compensation. Suddenly, that $250,000 cash package is a total first-year comp of nearly $290,000. And you're likely working 50 to 60 hours a week, not 90. You have weekends. You have a life. You are playing the long game. The people who choose this path are making a strategic calculation. They are trading a bit of short-term cash for an accelerated path to massive responsibility and a more sustainable career. 5 years out of an MBA, the banker might still be a vice president grinding on deals. The consultant might have made partner, but they're living on a plane. The LDP graduate? They could be a general manager running a $100 million business unit inside a global conglomerate. They have a team of 50 people, full control over a budget, and a direct line to the CEO. Their compensation at that point, with a much larger base, a huge performance bonus tied to their unit's success, and significant ongoing stock grants, can easily eclipse the consultants. We're talking total comp in the $500,000 to $700,000 range 5 to 7 years post-MBA, and they're just getting started. Now, LDPs are not the only route for the aspiring corporate titan. A parallel and arguably even more lucrative path is to go directly into a corporate strategy or corporate development role. Think of this as bringing consulting or investment banking in-house. A corporate strategy team at a company like Disney or Microsoft works on the CEO's most pressing problems. Should we enter the market in Southeast Asia? Should we acquire this competitor? How do we respond to this new technology? It's all the high-level thinking of a McKinsey project, but you are part of the team that actually has to live with the results. Because this role is so similar to consulting, the pay is benchmarked directly against it. For 2026, you're looking at a base salary of $185,000 to $200,000, right on par with MBB. The signing bonus and performance bonus structures are also nearly identical. Your first year all-in compensation will be comfortably over $300,000. The hours are better than consulting, there's no travel, and you have a direct impact on the one company you've chosen to build your career in. Similarly, corporate development is in-house M&A. You're the person at Google or Salesforce responsible for identifying, evaluating, and executing the acquisition of smaller tech companies. It's the deal-making thrill of investment banking without the punishing lifestyle of a bulge bracket firm. The pay is, again, phenomenal. It often tracks slightly higher than corporate strategy because of the finance skill set required, with total first-year compensation packages pushing $325,000 or more in 2026. But here is a secret that most MBA applicants don't understand. The biggest opportunities in the corporate world aren't always at the glamorous tech or media companies. Let me introduce you to the big fish, small pond strategy. There are hundreds of boring, but massively profitable Fortune 500 companies in sectors like industrial manufacturing, logistics, or agricultural technology. Think companies like John Deere, Caterpillar, or Honeywell. These giants are in a desperate war for talent against the sexier worlds of tech and finance. To lure a Harvard or Wharton MBA to their headquarters in Moline, Illinois, or Charlotte, North Carolina, they have to pay up. And they do. The compensation packages are often just as strong as the more well-known LDPs. But the real advantage is the speed of your ascent. At Google, you are competing with thousands of other brilliant MBA grads. At a less sexy industrial giant, you might be one of only a handful of top 10 MBA hires that year. The visibility you get is unparalleled. The CEO knows your name. You are given the toughest projects because they have invested so much in you. The path to a general manager or director role can be cut in half. You are a big fish in a very important, very wealthy pond. And while your friends are fighting for a promotion in a hyper-competitive office in New York or San Francisco, you are running a factory in the Midwest, getting mentored by the COO, and building a career that could genuinely land you in the C-suite by the time you're 40. It's a powerful and often overlooked strategy for long-term wealth and career satisfaction. So we've covered the Wall Street rainmakers, the elite consultants, the tech innovators building the future, and now the corporate titans climbing the ladder to the corner office. It seems like we've mapped out every possible high-paying path an MBA can offer. But what if there's one more? What if there's a hybrid path? One that combines the entrepreneurial upside of a startup with the stability of a large institution. A role that is consistently ranked as one of the highest in post-MBA salary surveys, yet one that almost no one talks about. We've saved the most interesting and perhaps the most lucrative path for last. And it's not what you think. It's the buy-side. But not just any buy-side role. We're talking about the absolute pinnacle of the investment world. The final boss of finance careers. We are talking about becoming an analyst or a portfolio manager at a hedge fund. Now, for many people, the term hedge fund conjures up images from the show Billions. High-stakes trades, immense wealth, and a level of autonomy that makes other finance jobs look like they're on rails. And honestly, that's not entirely wrong. A hedge fund is essentially a private, aggressively managed investment pool for a small group of sophisticated, wealthy investors. Their goal isn't just to beat the market. It's to generate absolute returns, meaning they aim to make money whether the stock market is going up, down, or sideways. They can invest in anything: stocks, bonds, currencies, commodities, and they can go long, or they can go short, betting that a company's price will fall. They are the financial world's special forces, operating with fewer restrictions and far higher stakes. And because the stakes are so high, the compensation is unlike almost anything else we've discussed. Forget the predictable salary bands of consulting or the structured bonuses of investment banking. Hedge fund compensation is a different beast entirely. It's built on a model famously known as 2 and 20. Let's break that down because this is where the numbers get truly mind-bending. The 2 refers to a 2% management fee. A fund charges its investors 2% of the total assets they manage every single year, just for keeping the lights on. So if a fund manages $1 billion, that's $20 million a year coming in regardless of performance. That $20 million pays for the office, the data terminals, the research, and of course the base salaries. For a fresh MBA graduate, that base salary will likely be in the neighborhood of $200,000 to $250,000 by 2026. It's a great number, but in this world it's almost irrelevant. It's just the starting pistol. The real money, the life-altering wealth, comes from the 20. This is the performance fee. The fund keeps 20% of all the profits it generates for its investors. So let's go back to our $1 billion fund. If the portfolio managers have a great year and generate a 20% return, that's a $200 million profit. The fund takes 20% of that profit. That's a $40 million bonus pool. $40 million. This is the carry, and it gets distributed among the partners and the analysts who generated the winning ideas. So, what does this mean for a newly minted MBA joining as an investment analyst? In your first year, if the fund performs well, your all-in compensation could realistically land anywhere between $500,000 and $800,000. If the fund has a spectacular year, breaking 7 figures is not out of the question. Let me repeat that. Your first year out of business school, it is possible to earn over $1 million. This is why it's the path we saved for last. The ceiling is effectively non-existent. By year 3 or 4, a successful analyst who has proven their ability to generate profitable ideas could be looking at an annual income of $1.5 to $3 million, or even more. Your pay is directly tied to the value you create. You are not a cog in a machine, you are the machine. Your research, your analysis, your conviction on a stock, it all translates directly into the fund's performance, and therefore into your pocket. Now you're probably thinking, sign me up. Where do I get this job? And this is the crucial part. This isn't a path you simply choose from a drop-down menu during on-campus recruiting. Hedge funds are notoriously insular and incredibly selective. They don't hire armies of MBAs the way McKinsey or Goldman Sachs do. A large multi-billion-dollar fund might hire only 2 or 3 MBAs in a given year, and they are only looking for a very specific profile. This is a post-MBA career that is almost exclusively reserved for individuals who had a strong pre-MBA track record in a specific field. The most common feeder is 2 to 3 years in investment banking, followed by 2 to 3 years in private equity. These candidates have already been through 2 of the most rigorous financial training grounds on the planet. They come into an MBA program already knowing how to tear apart a balance sheet and build a complex financial model in their sleep. For them, the MBA is not about learning the basics. It's a strategic 2-year pit stop. It's about gaining access to the powerful alumni network of a school like Wharton, Columbia, or Chicago Booth, schools renowned for their deep ties to the buy-side world. It's about honing their ability to develop and defend an investment thesis. The core of the hedge fund interview process is the stock pitch. You have to come in with 2 or 3 incredibly well-researched investment ideas, one to buy, one to short, and defend them against a grilling from some of the sharpest financial minds in the world. They want to see how you think, how you handle pressure, and whether you have true conviction. So while a top 10 MBA is almost a prerequisite, it doesn't guarantee you a thing. It's the price of admission just to get your ideas heard. The brand of the school acts as a powerful filter for these funds. They know that anyone who got into Harvard Business School or Stanford GSB has already cleared a dozen hurdles of intelligence, ambition, and grit. It de-risks the hiring process for them. But let's be clear, this path is a razor's edge. The immense reward comes with immense risk. There is zero job security. Your performance is tracked daily. You live and die by your P&L, your profit and loss statement. If you have a bad quarter, you're under pressure. If you have a bad year, you're likely out of a job. The fund itself could have a bad year and shut down entirely. The stress is relentless. You're not just managing money. You're managing the fortunes of endowments, pension funds, and incredibly wealthy families. A bad call doesn't just look bad on a slide. It results in millions of dollars of real losses. This is not a career for the faint of heart. It is for the truly obsessed. The people who thrive in this environment are those who genuinely love the intellectual puzzle of the markets, who are willing to go deeper on a company than anyone else, and who have the psychological fortitude to stick with their convictions when the entire market is screaming that they are wrong. So, as we wrap up this entire series, let's put it all in perspective. We've journeyed through the structured, prestigious world of consulting, with its clear path to a $500,000 income. We've explored the disruptive, equity-driven landscape of big tech. We've dived into the grueling but lucrative trenches of investment banking and the coveted, multi-million-dollar destination of private equity. And now we've seen the stratosphere, the high-stakes, high-reward world of hedge funds. The numbers we've discussed, $300,000, $500,000, $1 million, they can seem abstract, almost fantastical. But they are the very real outcome of a decision to invest in yourself by pursuing a degree from one of the world's elite institutions. The true value of a top MBA isn't just a salary figure. It's about buying yourself options. It's about gaining access. It's about opening doors to rooms you didn't even know existed. Whether you want the relative stability of a product manager role at Google or the eat-what-you-kill intensity of a hedge fund, a top-tier MBA makes those paths a possibility. The degree is the key, but it's your talent, your drive, and your performance that will determine how far you walk once that door is open. The salary is just the scoreboard. The real prize is the ability to choose the game you want to play.